This chapter we're going to be covering support and resistance, level 1, level 2, two different types of support and resistance levels. We're going to be covering our essential patterns. We're also going to be covering the concept of divergence. So here's a really nice quote by Jesse Livermore. It's about the stock market, but same thing applies about the Forex markets. The markets are never obvious. It is designed to fool most people most of the time. This is a really deep quote, right? It's designed to fool most people most of the time, and that's how the big banks make money. So once we align ourselves and our trades in the direction of the big money, right, we'll be able to, I guess, fool most people and most time and be in the direction of the big money. So let's take a look. So level 1 support and level 2 support. So as you can see here, price is breaking down, okay? Starts to form this range, which is, if you remember, could be a phase 1, stage 1, sideways base, okay? And this support right here, which has retested twice, right? You retested twice, that becomes our level 1 support. That's the first level of support, okay? But only, not the first time, because you don't know. The first time it bounced off it, that's not a level 1 support, okay? Because it hasn't confirmed if it's support or not. So when this area is held a second time and then it bounces, that makes it a significant area of support in the future. Okay, so if in the future prices were to come down here, that's where we look to buy and expect them to go back up. But now you can see here that this level becomes resistance. All right, tested once, falls, tested twice, starts to fall a little bit, but then finally breaks it. So now when it breaks it, what happens is on the way back down, all right, on the way back down, that area, which was initially resistance or supply, now acts as support. And you should expect buyers here. When you clear this resistance, you should always expect buyers when it comes back to retest that area, okay? Now, level 2 support is typically when a stock or a currency pair is in an uptrend and pulls back to the prior high and bounces. Now, what ends up happening is, now when this area breaks again, all right, now that makes this area the level 2 support. So now as prices move up, when they pull back, you can expect buyers to come in here. So the pivot highs in an uptrend become level 2 support, okay? And the equal lows in a downtrend or a sideways trend make it a level 1 support. Now here's another example. Check this out. Currency pairs moving up, pulls back, retests the area where it stopped previously, right? That makes it a level 1 resistance area because it was retested and it failed yet again, right? So it came here and it failed. So when it comes back up again to that same area, we get a retest and we can look to short, okay? Now, you can see here prices bounced off here, but when they come down, they start bouncing again a little bit, but then they drop. That support level breaks. So now what happens is on that way back up, that support area is now going to become resistance, level 2 resistance, okay? Now this is actually a great pattern in its own. Doesn't it look like an M, right? Like if you draw an M, the letter M, looks like an M shape. And this pattern is also known as an M top or a double top, okay? Same way, if you look at the previous slide again, this becomes a W pattern. The letter W, right? W bottom or double bottom. So we can see here that once this area of support is broken, that becomes resistance, all right? So you should expect sellers on the way back up to the testing of that support level, all right? All right, so let's take a look at support and resistance, right? Support lines. Now, support is mainly also known as demand, okay? That's where the demand or the buyers are. Now, support lines act as a floor and the prices areas where a currency pair finds it difficult to penetrate below the support line. Support lines are drawn through previous set of lows and can either pause in a downtrend or reverse depending on the strength of the support line. Some traders buy just that support line. That's as simple as that. So again, you can see here, prices come down, they bounce. They come down, they bounce. They come down, they bounce. We draw a line here because that is support. That's where there's demand for people wanting to buy. And just the opposite here, right? Resistance. Prices go up, fall. Prices go up, fall. So you can draw a resistance line, and the prices come back up again, you can expect them to fall again for a move back down. That is resistance or supply. Okay, now think about this one. Support changes into resistance. How does that happen? Well, same thing. This was support, right? Support, support. But when the support line finally breaks, and when it comes back up from below to above to touch that line, now that line which was initially support will turn into resistance. It's a really powerful concept. This is called change of polarity. Now here's a really good way of thinking about this pattern. Think about it. Let's say there's a ceiling, okay? There's a ceiling right above you. You somehow break the ceiling, right? You cause a little hole in that ceiling, and now you can climb above, right? So you climb up, you get above that building, right? Get above that hole in your ceiling, and what happens? Now you're standing on it, right? So now that ceiling, which was initially resistance for you, when you finally got above it, now that becomes your support. That becomes your floor now. So that's how you should think about it. And this is a really simple concept at heart, but it's fascinating to see a lot of traders don't get it. It's a simple concept, but if you just draw these lines on your charts, you will see these areas where you can play off of. Okay, so do not buy close to resistance line. That's how you're going to use it. So when prices look like this, they're coming back up into a prior high, don't buy, all right? And don't start selling when it's at support. You should always sell away from support or on a break of support. You should, right? And you should always buy at support, right? Or when the support resistance now becomes support. So you can even flip this pattern. So if this was resistance here, price it broke above resistance on the way back down, that'll become support. So we just covered that in an earlier chapter, right? So if this is support, this is our level 1 support, okay? Now if support breaks on the way back up, it becomes our level 2 resistance. As simple as that. All right, so in this video, I'm going to show you how to start up your trading account and how to download and set up MetaTrader 4 platform and how to use the platform. So number one, if you don't already have a trading account or don't already have a broker, looking for a demo account to try out, then go to our website, livetraders.com, click the About page, and then scroll down, and you'll see these two brokers right here. Okay, so if you're in the US, if you're in the United States, you click this, Trade Forex. Okay, if you're in the United States or Canada, you select this one. If you're outside the US, or if you're in Europe, if you're somewhere else, select this one. I personally have accounts with both brokers. So when I'm in the US, I'm using this broker with my US details. And I also have an offshore account with Pepperstone, which is also one that I use. Okay, so those are the two to use. So let's go over the setup process. FX choice, relatively simple process. You know, we can enter any email here, and you'll click the email. Okay, you'll enter your full name, country, mobile number. You'll click to proceed. So let's just enter anything random. So like United States. Now, if you're outside the US, you can still use FX choice, but I recommend Pepperstone, and we'll go over the reasons why. So just enter any mobile number. Okay, and then select MetaTrader 4 Classic Variable. So if you have less than $10,000 in your account, I suggest select MT4 Classic Variable. If you have more than $10,000, I suggest select MT4 Pro. You click this, you open live account, and voila, you have an account. Okay, you can, when you've opened this account, you can also create many demo accounts inside this to practice, or test your strategy. So that's not a problem. But inside this one account, you can open many other accounts. Okay, but use the link. So they know that you're under our team, they get added under our team. Now, if you're outside the US, okay, then I recommend Pepperstone. Why is that? Well, Pepperstone, because they provide 500 to 1 leverage. FX choice only provides 200 to 1 leverage. And as traders, we want to take as much leverage as we can get, even if we don't want to use it, right? Even if you're not going to use it, it's still better to just have a better leverage, right? So then you open an account with here, same thing. You'll click the link on the site. You go to their site, you click sign up, and it's a simple, straightforward process. Again, select MetaTrader 4 and click the normal classic account. They'll ask you, do you want a Razor account? Do you want some other account? Just select their standard. Okay. All right. So now I opened a demo account here to test out for you. then what I'm simply going to do is once you get your MT4 demo, you can just click this. You'll get a link here, download and install MetaTrader 4. You click that, you will ask to log in. When you log in, you will download MetaTrader, install it, just as you do any other application on your computer, and that's it. Now you have these demo details, okay? Okay, so the next step. So now we see we already have a MetaTrader 4 running. Again, this is my personal real account running right now, but we also got some demo account details. So we'll simply click File, log into Trade Account, okay? And we'll go into this area right here. We'll copy our account number. We'll copy the password. And then we'll copy also the server, right? So this is a demo server. My account has a real server, okay? So when you have a real trading account, you'll have a different server. When you have a demo account, you'll enter the demo server just as they showed it here. So demo01.pepperstone.com, demo01.pepperstone.com, and we'll click save. Again. All right, so now you can see here we have two accounts added. One of them is my live account, and the demo account will always say demo on top, okay? So here,
incoming mail.
Let's say my live account. You see here on top it says normal Pepperstone, which is a real account, okay? But when you click demo account, it'll say demo, okay? So now you have the demo account. So when you initially log in, you're not going to see charts looking like this. You're gonna see charts looking like this, all right? Which is green. It's got little grids on here, okay? And it looks pretty ugly. So here's what we need to do to make your chart look similar to mine. So number one, on here on top, we'll click candlesticks, okay? So now we have candlestick charts. If you zoom in a little bit, you'll be able to see candlesticks as we covered in the basic course. And then simply all you need to do is, first thing is you need to remove grids. So I'll just change the color to grid to black, make it same as the background. And then I'll also edit the candlestick colors to make it easy, okay? So we'll do bar up. We'll select, we'll select the little gray silver here. Bar down, we'll select silver. But bull candle, we will select, let's select green, okay? Then bear candle, we'll select red, all right? And then that's it. We'll click OK, and there you go. Your charts look exactly like mine now. And another thing you might want to do is change the color of your trend line. So how do we draw a trend line? So now we have these charts available. Well, how do we manipulate this chart? So here's the thing. So once you have your charts looking like this, another thing you should do is you see this little button right here, Shift N to the chart, click that. So what that does is it moves the chart and gives you some empty space in here. That's always really good for drawing trend lines, right? How do we draw trend lines? Number one, you see this little thing right here? This is a horizontal line. This is a trend line, right? This is our Fibonacci. So to draw a trend line, we'll simply draw the trend line here, and it'll draw something like this. Now, yours will look different because that's your settings. So what you need to do is when you draw your trend line is gonna probably be red in color. It's gonna be looking really different than mine. So you right click it, click trend line properties, and you can change it to wherever you want. You can change the color, whatever color you want. Some people prefer on a black background, they like white. And there you go, you can change it to white. You can change the color as you like it. And you can even change it. Do you want a dotted line? Do you want a straight line with no dots, right? You can change all these stuff in here. You can even change the width of the line. Maybe you want a fat line, but some people like it. And it's actually really good. I like it as well. So that's how you will edit, how you want your trend line to look. As far as my trend line, I just have it changed to a dot, right? And that's about it. Have it changed to a dot, have a yellow in color, and you don't need to do anything. Also, another thing you might want to do is your trend line will automatically look something like this, where you're not able to, draw it, because when you draw it, it automatically starts going to the right. And some people prefer that, because then you don't need to draw your trend lines, because when it comes back to this trend line right here, it's going to act as resistance. But what I like to do is I like to draw them manually. So what I will do, again, trend line properties, go to parameters, and then uncheck this box called ray. And now you see, now we can draw our trend lines the way we want it to be. Maybe we want it till here. Maybe we want it till here, right? So that's how you draw your trend line. Fibonacci, same way. You have this Fibonacci right here, right? You drag it high to low, and now we have our Fibonacci levels. And look what it is. It came down to 618, starting to bounce a little bit here. Okay, so that's how you draw a trend Fibonacci. And again, your Fibonacci might look different than mine. Click Fibo properties. You can change the color as you want it to be, and you have Fibo levels here. You can change them as you like. Okay, so for me, I don't like to look at this 4.2. I'll delete it. I don't like to look at this level. I'll delete this one. I'll delete the 100%, right? And I will delete the 23%, and I will delete the 0%, and I will add a couple other levels. You know, I will add the 72 retracement, and I will add the 618 1.272. Okay, and there you go. We added the levels right there, and yeah, there you go. All right, so now we've changed it, and now you can see the levels have changed to only show the ones that we want to look at. All right, so that's how you do the trend lines. That's how you draw our trend lines and Fibonacci's. Horizontal line, same thing. We can draw a horizontal line. It'll just draw our horizontal support and resistance. Usually, I like them plain white lines on a black background. They look the best, so I can distinguish between my trend line and my horizontal line. Okay. Now, maybe you want to draw spaces. Okay. So how would you draw spaces right here? Okay, let's go to the 4-hour chart on the Euro USD, and we notice that this is a really good area of demand. So we'll insert, we'll go to shapes, rectangle, and there you go. We can draw rectangle shapes like this, right? Maybe we want to draw triangles. Same thing, shapes. You can draw triangle like that. Okay, so you just play around with this. Everything's in here. You want to write something on the chart, you can just write it here, right? Text, testing. You can change the font colors, and you can write and annotate on your charts. Okay, now everything is in here. Lines are in here, Fibonacci's are in here. So in case you don't see this on here, you can click on insert, and you'll be able to see it there too. If you want to add indicators on your chart, like moving averages, you go to indicator, you go to trend, you go to moving average, and there you go. You can add that's an exponential 50 moving average. And there you go. Now you have your moving average on your chart. Okay, so that's how you edit and change things, add indicators. Everything is in here. And another thing you can do is, you see this time frames here. So these are time frame. MN is monthly chart. W1 is weekly chart, right? D is daily chart, which is each candle is 1 day. Go to 4-hour chart, each candle is 4 hours. Each candle is an hour, and that's how you manipulate this whole area. Okay, to zoom in and out, you can just click zoom out, zoom in, or you can even drag this bottom of the chart. If you drag it left, it zooms out. If you drag it right, it zooms in. Okay, same thing here. If you go down, it shrinks the chart. If you go up, it makes the chart much more bigger. So that's how you do it. And a couple of things you can probably do. So let's say you want to look at, I mean, this is your whatever symbols your brokers have. Sometimes, as you see here, not all the symbols are available. So what we will do is we will click hide all, okay, and we will click show all. Now that'll show you all the instruments that your broker allows you to trade. Okay, we'll simply drag it and drop it on the chart. So you want to look at the Aussie dollar, you drag it and you drop it on the chart, and it updates to Aussie dollar. Okay, as simple as that. You can draw trend lines just like this. Notice how, you know, it broke the trend line right there, and look at the drop we got. Awesome drop. Okay, so that's how you draw a trend line. That's how you manipulate your chart. Just make sure you save it, because if you make all your charts and then you close it and then you open it again, it's probably not going to show up. So what you need to do is you need to save it. Okay, you will click save as, and you can save this layout. Okay, or you can go here into you know, this charts template, and then you can click save template. So now you can save the template. And now next time, let's say you mess something up or your charts don't look right, you can pretty simply do charts, template, and you can load the template, okay? So for example, we'll click save template, we'll change the name, we'll save it, okay? And let's say now we mess up the charts by mistake. Like, oh shit, our charts look horrible. Well, we'll just go to charts, template, and load the new template that we made. And now our charts look fine again. If you ever need to open a new chart, you click file, new chart, okay? And all your trading accounts will show up in here. So for example, you can easily switch from one trading account to another. So right now we opened a demo account just for this purposes. Okay, we can do that. Or if you want to log into my live account, I can click that and I can log into my live account with one click of a button. So that is the MetaTrader 4 platform. Another thing you can find useful is how to calculate pips. Okay, so let's say, you know, we get in long in this currency pair. We want to get in long, let's say. We want to get in long here. And we're looking for our target into here. And now we want to know how much pips is that. I mean, you can always calculate, right, by looking at the prices. But here's a really cool trick that not many people know. You take the crosshair tool right here, you drag it from your entry, and you move it up. And now do you see? It shows the second number. Look, notice the second number. Okay, it says 844, right? 844. But you basically divide that into 10 and you get 84 pips. Again, on the daily chart. So let's say we want to take from here to here how many pips that is. We see it says 12175. We just divide it by 10, right? 12175 divided by 10. It's a simple math, but you can do it just on the calculator. 5 divided by 10. So that is going to be about 1,200 pips. Okay, so that's how you drag and drop it to calculate how many pips that is. Okay, so now since this is a demo account, how to place an order. Okay, so number one thing you can do is you can click here, enable one-click trading. So one-click trading, you have to be careful with this. One-click trading, whatever lot size, so you can enter your lot size here. So this is a mini lot. Okay, you want to change it, you can. This is a one lot. Change your lot size, and you can edit it really simply. And when you click buy, it'll automatically buy it for you. When you click sell, it'll sell it. So be very careful not to click it by mistake. So one thing to avoid it is you can just click one-click trading and just make it disappear. Okay, and what you can do is, let's say you want to trade the pound US dollar. All right, so let's say you notice this rectangle pattern right here. Okay, you notice this rectangle pattern right here, and you think, all right, this is a bear flag, looks like this wants to drop, and now you want to short it under the lows. How would you do that? I simply click trading, you'll click new order. All right, now notice here it says type market execution. Okay, so in a market execution, if you just click buy right now, it'll buy it for you at this price. If you remember, bid and the ask, so this is the ask price. If you click buy right now, it'll buy it at this price. If you click sell right now, it'll sell it at this price. So let's try it. Let's just click buy. Boom, we just bought it at this price. Okay, as simple as that. And now what you want to do, let's say we don't want to be in this trade, what are we going to do then? Let's take a look. All right, so we notice we bought this position and it displays here, okay, that we bought this much pound USD at this price. And notice we don't have any stop loss or target entered. How do we enter a stop loss and a target? Before we do that, let's just do it right now. Modify, you'll right click it, you click modify and delete order, and you'll enter your stop loss. So let's say we put in our stop loss 1.27, 1.231005, okay, 1.31005. All right, and let's say we want to put in a target as well right here. So we just bought this currency pair right at this support 31005, put our stop loss 1.27505, and we'll just click modify. And notice how our stop loss has already gone in here, our target has already gone in here. So now if you want to notice, okay, how much am I going to make if I hit my target? You'll put your mouse over this red line and see it shows we're going to make $120 or 240 pips. Okay, If I stop out, how much am I going to lose? You're going to see here. You're going to lose $54 if you stop out, or you're going to lose about 100 pips. Okay, so that's how you calculate. And on the chart, it'll visually display where your stop is. You can see SL is stop loss. There's where you bought it. There's your TP is target. Now, let's say you decide, all right, I just don't want to be in this position. I want to exit this position right now. You just simply click this X button right here. Okay, you'll accept the terms. And then you click the X again. There you go. All positions automatically close. The order is no longer here. And when you click your account history, you will see you had bought pound USD and you closed the trade. You lost $1.95. Okay. Now, let's say we want to put a pending order. We don't want to get it in right now, but we want to get in, let's say if it gets below the support level, we want to short it. Okay. And we're going to try and short it there. So how do we do that? Trading, new order. Now, instead of market execution, we'll click pending order. We'll select sell stop and we'll enter our entry price. So 1.27, let's get 510. And we want to place our stop loss at 1.31005. Okay. And let's say we want to put our target at 1.260. There you go. So now I order, you can see here, it's not an open position, right? It just says this is a sell stop order. It has not triggered. So any pending orders will show below your balance line. Okay. And any order that we buy right now will show above the balance line. So here, again, let's take the euro example. We'll just buy this randomly right now. Okay. All right. So let's just cancel that for a second here. I want to buy a right market order, new order. So we just bought it. So now see how open position will display above pending, above the balance, and pending order will play below the balance. And you can always, again, if you want to cancel this order, you change your mind, you can always just click X. This order will disappear. So let's close out this euro US dollar. Let's look at this pound USD. Let's go to the weekly chart. And we can always do this if your charts are not totally clear. And we can see here, that's our target, that's our stop loss, that's our position. Okay, now if you want to, let's say your position's going in your favor, all right, you're doing really well. You're like, okay, I don't want to put my stop loss still there. It's dropping in my favor. You can take this stop loss, you can drag it lower. There you go. So now you've lowered your stop loss. It's automatically updated by just dragging and dropping the line. Okay. Now let's say you want to get in early. You can always do this to get in early and lower your stop loss like this. You can always change everything. You can even change your target, right? Maybe you can raise your target a little bit. So that's how you can update these things in real time. Okay. Now here's another handy trick. So let's say we buy something, we buy the pound USD again. Let's say at market prices. Okay. So now you've put in just the entry. We bought it right now at the market. We want to update our stop loss and target. Here's what we can do. Let's go to the right here. Okay, so we can drag this entry line and drag it up. If we drag it up on a buy, it'll automatically place our target. Let's say we drag it again, it automatically puts our stop loss. So that's how easy it is to trade on MetaTrader 4. Okay, so that's how you would trade. So we went over how to set up charts. We went over how to place and sell orders. We went over how to, look at these stocks by dragging and dropping, how to add indicators, how to open an account, what these different time frames are, how to pan your charts, drawing trend lines, Fibonacci, and what else can I show you about this platform? I mean, that's really all that's required to trade well. Okay, so that's about it. Hopefully this helps, and I'll speak to you guys later. All right, so this chapter we're going to cover our essential FX patterns, and let's get started. So chapter 5. So in this chapter we're going to be covering support and resistance, level 1, level 2, two different types of support and resistance levels. We're going to be covering our essential patterns. We're also going to be covering the concept of divergence. So here's a really nice quote by Jesse Livermore. It's about the stock market, but same thing applies about the Forex markets. The markets are never obvious. It is designed to fool most people most of the time. This is a really deep quote, right? It's designed to fool most people most of the time. And that's how the big banks make money. So once we align ourselves and our trades in the direction of the big money, right, we'll be able to, I guess, fool most people and most time and be in the direction of the big money. So let's take a look. So level 1 support and level 2 support. So as you can see here, price is breaking down, okay? Starts to form this range, which is, if you remember, could be a phase 1, stage 1 sideways base, okay? And this support right here, which has retested twice, right? You retested twice, that becomes our level 1 support. That's the first level of support, okay? But only, not the first time, because you don't know. The first time it bounced off it, that's not a level 1 support, okay? Because it hasn't confirmed if it's support or not. So when this area is held a second time and then it bounces, that makes it a significant area of support in the future, okay? So if in the future prices were to come down here, that's where we look to buy and expect them to go back up. But now, you can see here that this level becomes resistance, all right? Tested once, falls. Tested twice, starts to fall a little bit, but then finally breaks it. So now when it breaks it, what happens is on the way back down, all right, on the way back down, that area, which was initially resistance or supply, now acts as support. And you should expect buyers here. When you clear this resistance, you should always expect buyers when it comes back to retest that area, okay? Now, level 2 support is typically when a stock or a currency pair is in an uptrend and pulls back to the prior high and bounces. Now, what ends up happening is, now when this area breaks again, all right, now that makes this area the level 2 support. So now as prices move up, when they pull back, you can expect buyers to come in here. So the pivot highs in an uptrend become level 2 support, okay? And the equal lows in a downtrend or a sideways trend make it a level 1 support. Now here's another example. Check this out. Currency pair is moving up, pulls back, retests the area where it stopped previously, right? That makes it a level 1 resistance area because it was retested and it failed yet again, right? So it came here and it failed. So when it comes back up again to that same area, we get a retest and we can look to short, okay? Now, you can see here prices bounced off here, but when they come down, they start bouncing again a little bit, but then they drop. That support level breaks. So now what happens is on that way back up, that support area is now going to become resistance, level 2 resistance, okay? Now this is actually a great pattern in its own. Doesn't it look like an M, right? Like if you draw an M, the letter M, looks like an M shape. And this pattern is also known as an M top or a double top, okay? Same way, if you look at the previous slide again, this becomes a W pattern. The letter W, right? W bottom or double bottom. So we can see here that once this area of support is broken, that becomes resistance, all right? So you should expect sellers on the way back up to the testing of that support level, all right? Now, here's a pattern which is commonly seen in a lot of currency pairs, is the bearish pennant. This is a pretty common pattern. You will see this often on a daily chart, weekly chart, 4-hour chart, hourly chart. I mean, you can see this in all different time frames, okay? So here's what the bearish pennant looks like. They're similar to bearish flag, but have a triangle pattern to it, okay? Now, why does this pattern work, right? Before we cover that, let's cover the pattern. So we can see here prices are dropping. They bounce, let's say halfway to that drop. They come down again, hold this area of support, right? Come back again, make a lower high, come back down again, bounce again right up into this area, come back up again, fail, and then they finally break down. So this is what a bearish pennant would look like. It consists of higher lows, right? You can see here, higher low, higher low, higher low. We can see here, lower high, lower high, lower high. So when you get lower highs but higher lows, that forms a bearish pennant. Now, why does this pattern work? Well, here's why. This is a range contraction pattern, okay? The ranges are getting tighter. Prices drop, rally, drop, rally, and you can see how it's getting tighter, and you can see how the triangle is. The triangle is broader, right? The triangle is broader and it gets tighter and tighter and tighter. And as it approaches the end of this pattern, right, prices get squeezed. Like, think of it like a spring, right? If you have on your palm of your hand, you have a spring. And from your other hand, if you push down on that spring, what happens? The spring gets tighter, 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 and smaller. But what happens when you let go, right? When you let go of your hand, that spring expands. So this is what's happening. You got a big drop, okay? Range expansion. Then you start getting range contraction. Prices getting tighter, tighter, tighter. Spring lets go. You get a drop, okay? That's how you would draw it. The way you would draw it is to connect these lower highs and connect the higher lows. This will give you this bearish pennant pattern, and you will look to short when it breaks down under this pattern, okay? So that's a great pattern. You can find these on all different time frames. Now, this can also be known as a symmetrical triangle, okay? Symmetrical triangle is a formation in which the slope of the price highs and lows are converging to a point. Support and resistance are sloping, okay? Symmetrical triangles are formed by rallies and sell-offs, each smaller than the last. As time moves on, an event is imminent. The move will be explosive. So you need to place your buy order on a break up and out of the triangle, but the price could go in the opposite direction. So you can always look to short as well. So again, you're getting higher lows, you're getting lower highs, right? Connect these lows and the highs, you getting this triangle pattern, and you're gonna not look to trade in between that triangle. Because when you try and trade in between that triangle, it's really tough trading. So let it break. When it finally breaks the triangle to the upside, that's where you're gonna look to buy. And look to place your stop loss somewhere down in here, and you're going to look for target of higher highs, okay? Same thing here, but if it breaks to the downside, you could look to short it as well for further downside. Now here's a descending triangle, okay? Again, you can already see it's self-explanatory. Descending triangle, you know, is mainly formed by, again, lower highs, okay, which causes the descending line, lower highs. But the lows this time, instead of being higher lows, are equal lows. So you get a flat bottom line and a downtrending line that forms this descending triangle. Okay? The defining characteristic of a descending right angle triangle is the pattern of declining highs and a series of equal lows. The combination of points can be connected to form a right angle triangle. The hypotenuse should be sloping from higher to lower and left to right. Okay, so that's what it is. An illusory double bottom invites one last batch of weak hands to buy just before a sharp break and major selling ensues. Sell when price breaks out and down of this pattern. Okay, so descending triangles are pretty reliable patterns because of both supply and demand are easily identifiable. Now, why does this pattern work? Let's just take a look behind the psychology of the pattern, okay? So prices are going down, so that signals to us we are in a bearish trend. And now you see how buyers stepped up here, prices moved up a little bit, came down again, buyers stepped up again, pushed the price higher, buyers stepped up again, pushed the price higher. But look what's happening though. Yes, the buyers are stepping up at this level, but also look at the sellers. The sellers are stepping down. Sellers are getting more aggressive, right? The buyers are not getting aggressive. So if the buyers were getting aggressive and the buyers were looking to buy this currency pair up, this would form a higher low. But it's forming equal low. That tells us the buyers are sitting here willing to buy it, but look how the sellers are slowly and slowly getting aggressive, right? They were first selling here. Now they came down, they're selling it here. Now they came down and selling it here. So as the pattern gets tighter, it comes to a point where the sellers just keep coming down and get to a point where they just whack the bids, right? Whack the currency pair, and the buyers finally drop out, right? There's no more buyers. They bought all they wanted to buy. What also happens, if anybody has bought the currency pair here, here, and here, they have their stop losses right here. So now they're getting stopped out. Sellers are getting aggressive. This causes a drop in this pattern. So you can look to short here, place your stop loss above the last swing high, and look for a nice move down. Again, here's another look at symmetrical triangle. You're going to look to place your buy order above the break of the symmetrical triangle or below the symmetrical triangle if you're looking to short. Now here's an ascending triangle, the opposite of the descending triangle that we just covered. right? Now this is a formation in which the slope of price highs and the slope of price lows are converging to a point where the resistance line is parallel to the bottom of the chart, okay, while the support line is sloping up. So simple thing, just the opposite of that. Now in this case, the sellers are sitting here, right? They're wanting to sell the stock here. They want to sell this currency pair here. It comes back up, they're selling here. So, but they are selling here. They're just sitting here, waiting to sell. But look at the buyers, they're getting much more aggressive. They're stepping up, they're stepping up, they're stepping up, okay? When the price finally breaks, whoever wanted to sell has sold and the sellers are getting stopped out, buyers are getting more aggressive. That causes a break in this pattern to the upside. Now you're going to look to buy above the highs of all these candles by a few pips, right? Maybe 5 pips above this pattern, okay? You're going to place your stop loss below the last swing low and you're going to look for a nice move to the upside. All right, so let's take a look at support and resistance, right? Support lines. Now support is mainly also known as demand, okay? That's where the demand or the buyers are. Now support lines act as a floor and the prices areas where a currency pair finds it difficult to penetrate below the support line. Support lines are drawn through previous set of lows and can either pause in a downtrend or reverse depending on the strength of the support line. Some traders buy just that support line. That's as simple as that. So again, you can see here, prices come down, they bounce. They come down, they bounce. They come down, they bounce. We draw a line here because that is support. That's where there's demand for people wanting to buy. And just the opposite here, right? Resistance. Prices go up, fall. Prices go up, fall. So you can draw a resistance line and the prices come back up again. You can expect them to fall again for a move back down. That is resistance or supply. Okay, now think about this one. Support changes into resistance. How does that happen? Well, same thing. This was support, right? Support, support. But when the support line finally breaks and when it comes back up from below to above to touch that line, now that line which was initially support will turn into resistance. It's a really powerful concept. This is called change of polarity. Now here's a really good way of thinking about this pattern. Think about it, let's say there's a ceiling, okay? There's a ceiling right above you. You somehow break the ceiling, right? You cause a little hole in that ceiling and now you can climb above, right? So you climb up, you get above that building, right? Get above that hole in your ceiling and what happens? Now you're standing on it, right? So now that ceiling, which was initially resistance for you, when you finally got above it, now that becomes your support. That becomes your floor now. So that's how you should think about it. And this is a really simple concept at heart, but it's fascinating to see a lot of traders don't get it. It's a simple concept. But if you just draw these lines on your charts, you will see these areas where you can play off of, okay? So do not buy close to resistance line. That's how you're going to use it. So when prices look like this, they're coming back up into a prior high. Don't buy, right? And don't start selling when it's at support. You should always sell away from support or on a break of support. You should, right? And you should always buy at support, right? Or when the support resistance now becomes support. So you can even flip this pattern. So if this was resistance here, price it broke above resistance, on the way back down, that'll become support. So we just covered that in an earlier chapter, right? So if this is support, this is our level 1 support, okay? Now if support breaks, on the way back up, it becomes our level 2 resistance. As simple as that. Now here's another pattern, descending wedge. Now this formation occurs when the slope of the price candle highs and lows join at a point, form a declining wedge. The slope of both lines is down, with the upper line being steeper than the lower one. To trade this pattern, place an order on a break out of the wedge. So simple thing, you're getting lower highs, okay, but you're also sort of getting your lower lows. So this price is also trending down. So when these two converge, it forms a wedge type of pattern, and you are looking to buy on a break above this pattern. Now, this is a really powerful pattern, which we'll also cover in much more detail in later chapters, the divergence chapter, because this pattern is also known as divergence. This will show up as divergence on your MACD or your RSI indicators. Okay, so you're going to look to buy above the break of these patterns. Now here's an ascending wedge. Okay, this pattern occurs when the slope of price candle highs and lows join at a point, forming an inclining wedge. The slope of both lines is up, with the lower line being steeper than the higher one. Okay, same thing here. You're getting your higher highs, you're also getting your higher lows, but the angle is much more steeper. So when you connect it, you get this type of divergence pattern. When prices break through it, you're going to look to short, place your stop loss above, and look for the next support levels as your target. All right. Now, here are upward and downward trend lines. Okay. So trend lines can be defined as borderlines for making buy or sell decisions. Trend lines form the boundary lines for most of the chart patterns, as will be seen later on. So a trend line of about 45 degrees is considered the most reliable, right? So when the trend line looks like this, where it's in a 45-degree angle, those are the most reliable. The most unreliable trend lines are either too steep, right? Maybe 90-degree angle or 70-degree angle. When they're too steep, they're not reliable. They're not good trend lines. When it's too flat, then it's also not that great. 45 degrees is a perfect trend. It's called a power trend. Okay, so anything steeper than 45 degrees, the market typically cannot sustain that kind of momentum for long. Watch to see how the market bounces off these trend lines or slices through it, and watch and wait for retest of these trend lines. So again, these are simple patterns, guys, but that's how you got to trade. You got to make these simple patterns the essence of your trading. Okay, simple thing. This is making higher lows and higher highs. It's an uptrend, just like we covered in the uptrend chapter, right? When you connect these lower lows, you can draw your trend line. And as simple as that, you're going to look to short break off those trend lines or buy bounces of those trend lines. Same thing here. You get a downward trend line here. Prices touch it, get rejected. Touch it, get rejected. You connect these 2 points. So the third time it touches it, you're going to look to short. And when it finally breaks above it, you're going to look to buy. These are great trades. Now here's a channel. Now channels happen when two parallel trend lines form. Okay, when prices hit the bottom trend line, they bounce, and prices hit the upper trend line, they sell off. This creates a parallel line of support and resistance, creating a channel-like formation. Right? Prices go up, they come down, they bounce, they go up, they fall, they come down, they bounce. So simple way to trade channels: look to buy bounces on the lower trend line, look to sell or take targets at the upward trend line. Here's a bullish rectangle pattern. Now these bullish rectangle patterns are most reliable on weekly charts or daily charts or 4-hour charts. Anything lower time frame, you get a lot of fake breakouts and you get a lot of fake shakeouts by market makers. So a bullish rectangle pattern is when the market is flat. Okay, so we're going to draw a line of our highs and line of our lows. We get this rectangle pattern. So when prices finally break above this rectangle pattern, that's we're going to look to buy, place our stop loss somewhere in here, and look for continuation of this trend to the upside, just like we covered in our earlier chapter where we showed you stages, right? In between different stages, if the currency pair is in a stage 2 uptrend, you're going to get a little consolidation and then a continuation higher. Now on the opposite side, here's a bearish rectangle pattern, right? Prices are consolidating sideways. You draw these lines and you're going to look to sell this currency pair when it breaks this to the downside. Here's another example. So how would we determine the target, right? So let's say we do buy this currency pair when it gets above this rectangle pattern. Where do we sell, right? You've bought it. Now what's my target? What's my take profit? Simple. You're going to draw the line from the high to the low of this rectangle pattern. You're going to get this length of the pattern. You're going to take this length and put it where it broke out from, and that's going to be your minimum target, right? Same thing here, right? Draw the line from high to low, take this line, put it from where the price broke down. That is going to be your target. All right, so here's a uptrending bullish pennant. So if you really look at it in a nutshell, right? If you really look at it in a nutshell, pennants, symmetrical triangles, wedges, they're all the same pattern. What you're essentially doing is you're connecting the lows, you're connecting the highs, and you're going to get these patterns. Now this particular pattern is known as a bullish pennant. This looks similar to a symmetrical triangle, but it's typically much smaller in size, the duration of the pattern. They're much smaller. Like symmetrical wedges might form over a series of days, weeks, and months, whereas this one might be relatively shorter in duration. So also, sort of known as a bullish flag pattern, but rather than a flag, it's got a pennant. Okay, so this becomes our kind of a flag pole. This becomes our flag. You're going to look to buy when this pattern breaks to the upside. When this trend line breaks, you're going to look to place your stop loss here and look for higher highs. Here's the difference between, I guess, a flag and a pennant. Okay, so here's a bull flag. Bull flag is when the prices are moving up and they come down just like a flag, right? You're going to look to enter when the pattern breaks. Place your stop loss below the last swing low. You look for target 1 and then target 2. Here's a bull triangle. Same thing here. You look to buy above the break of that pattern. Place your stop loss below the last swing low and look for highs right here. See that? And look to buy right there when it's breaking right here. Stop loss right here. Look for target highs. Again, same thing here. To recap, we're going to look to buy when this pattern breaks. Place our stop loss right under here. Look for continuation to the upside. Alright, so here's a bullish flag. The bull flags are characterized by lower highs and lower lows with patterns slanting against the trend. So why do we call it a bull flag? I mean, think about it. If you're holding a flag in your hand, right, that's your flag pole, right, and that's your consolidation sideways. So this becomes a channel almost, right? We just covered channels earlier. So this is basically just a channel after a nice strong move. So after you get a nice strong move to the upside, prices consolidate. You can draw your channel lines. When the channel breaks, you're going to look to buy. Now, why does this pattern work? Let's dive into the psychology of this pattern. Basically, prices can't go up, right, or go down straight away. I mean, prices just don't go straight up or go straight down. They go up, they ebb and flow, right? They ebb and flow. They go up, they consolidate. They go up, they consolidate. So just like think about if you were running, a marathon, right? That's how you got to think about charts. Charts are basically in marathons. If you ask them to sprint, just like sprint 100-meter dash, right? That's what happened here. Prices sprinted. What happened? After you sprint for a while, you get tired. You rest a little bit. Prices rest. After resting, they're ready to go again. That's why the pattern breaks, right? Here's a bearish flag, just the opposite. When you get a channel line you can draw after a bearish down move, you're going to look to short the break of that channel. Again, bearish flags have higher highs and higher lows, forming a channel. When that channel or trend line breaks, that's where you're going to look to sell. Let's take a look at some real life charts and examples, okay? So we can see here, we're getting an ascending wedge. On the break of the wedge, we're going to look to short. And look at that, prices dropped right back down to this level 1 support. Get another bearish wedge, look to short. Prices drop back down to level 1 support. And look what happens again. Prices break level 1 support, retest. That becomes level 2 support, level 2 resistance. Prices drop again. Here's another example. Prices in a strong move start to form a descending wedge. That descending wedge breaks. We look to buy, place our stop loss right here, and prices explode higher. Just like we covered, right? Prices sprinted for a while. They got tired now. We got to rest a little bit. Finally break, ready for another explosive move. What happens after that explosive move? Prices consolidate again. Here's another one. Bearish rectangle, okay, after a downtrending move. So prices are going down. This is a pound USD. Prices go down, right? They sprint. What happens? They need to rest a little bit. They go sideways, forming a bearish rectangle, okay? Prices break. We're going to look to short here, place our stop loss there, and prices continue lower. Here's another one, bullish rectangle. Strong, nice move to the upside in the euro dollar. Prices consolidate. Prices break above it. We're going to look to buy. Prices move up again. Now here are channels. Okay, this is a USD Swiss franc. Prices go up, they go down, they go up, they go down, forming a channel. When a channel breaks here, we look to short, and prices get into another channel, to the flip side, downtrending channel. When we ride our short trade down, finally breaks again, you can flip it and go long again. Prices go back up again in an uptrending channel. Now here's an example of an ascending triangle, okay? Prices are making higher lows while making equal highs, all right? Pattern breaks, look to buy, and prices explode to the upside. And now look what's happening. Now I haven't drawn the lines here, but look what's happening here. After sprinting, prices got tired again. They rest a little bit. Now if I connect it again, this will form a bullish flag. We're going to look to buy again. Okay, so here's another example here. The descending triangle. So prices are making lower highs. We connect this line. Prices are making equal lows. We connect that line. And now we're just going to wait. Pattern finally breaks here. Look to short, place our stop loss above the last swing high, and look to ride it back down. So that's what you're essentially doing as technical pattern traders. We're not trading it every day. We're not trading it in here in this junk, right? We're not trading it in here in this junk. We're waiting for these patterns to form and looking to break off those patterns. Here's some more examples. Symmetrical triangle. Prices sprint in an uptrend, go up, right? Start making this kind of triangle here, breaks the triangle, explode. Another here in a downtrend, all right, pattern breaks, starts consolidating sideways. We're going to look to short on the break of this trend line. Okay, now a lot of people ask, hey, how do we know, is it going to be a long or a short? Well, here's a simple answer. First thing, if it breaks to the upside, it's going to be a long. If it breaks to the downside, it's going to be a short, right? But also you look at the prior trend. So if this pattern had broken to the downside instead of going to the upside, I would actually be a lot more careful and a lot more wary of shorting it. Why? Because the last move was up. You want to play these patterns as continuation patterns in the direction of the last trend. So in this case, direction was up. So you're going to look to buy rather than sell a break of this pattern. In this case, we look to sell. Why? Because the previous move was down. Okay? Now check it out here. Lower highs, getting higher lows, pattern forming, breaks to the upside, look to buy, prices explode higher. Here's some more. In an uptrend, prices go up, rest a little bit, forming this bull flag or channel, breakout, explode higher. Prices after exploding higher need to rest again, forming another channel, another bull flag, look to buy. Here's another one, bearish flag. Prices going down, start rallying up, forming this bearish flag or channel, short. Prices drop again. Now this could actually be a horizontal pattern as well. If I draw a line here and I draw a line there, that actually becomes a rectangle bearish pattern as well. Prices break down, rally a little bit, forming this channel, bearish flag, look to short again. Okay, now look at this pattern. First of all, we can even do a horizontal line here. We get a bearish rectangle, breaks down, comes back up, forms a bullish pennant, buy it above there, price breaks out. Next, what's the target going to be? Well, last resistance here. Look to the left. What happened to the left? Prices stopped here. We're going to draw a line here. If you buy it here, that's going to be our target. All right, now let's cover another strategy, which is the double top strategy. And we also, we've covered, these are all variations to understand the pattern. What we've already covered. We've covered the level 2 and level 1 resistance. We've covered the M tops, right? We've covered the double top, and now we're covering the double top in much more detail. Okay, so prices are in an uptrend. Okay, price make a swing high followed by a slight retracement, and after pulling back to the trend line, price makes another attempt to continue the uptrend, but instead of making a new high, prices stop at or near the last high. So instead of continuing this uptrend and forming a new high, it fails at that high. So what we're going to look to do is we're going to look to short when it breaks the trend line, or when it breaks this last support area, this level 2 support area. When it breaks it, look to short, right? What's the target going to be? Well, same thing. We draw from high to low of that range, take it from where prices broke. That's going to be our minimum price target. And notice here again, when the prices broke, let's say you missed the trade. Let's say you just totally missed the trade. It gave you another chance. Prices broke, but then came back to test, which was support. And now that support becomes resistance, level 2 resistance. We'll look to short it there and write it down. I actually prefer the retest because it's more confirmation and a better reward to risk play. Now the opposite side, a double bottom strategy. Prices are in a downtrend. Connect these downtrend line, we get a nice downtrend. What happens then? Prices break the trend line, they hold the support, break the trend line, and the same pattern ensues. So just like this was an M top, right? M shape right here. This becomes a W shape right there. Okay, so double bottom is essentially the opposite of a double top and occurs when price reaches a valley twice during a short period. Okay, but instead of continuing down, price is just held here. So confirm level 1 support, prices break, resistance, pull back, that becomes a level 2 support now. And again, same thing. You're gonna look to buy this retest or break of this trend line and look for prices to move higher. All right, so now we're gonna cover the head and shoulder strategy. Now, head and shoulders is a really powerful pattern, but it's best played more on the daily, the 4-hour, and the weekly chart. Okay. Now, head and shoulders pattern is as simple as it looks, right? I mean, you get this little thing here becomes left shoulder. So think of it as a human body. So this is our head, and we have left shoulders and we have right shoulders, right? Same thing with the pattern. There's left shoulder, there's a head, and there's a right shoulder. Right, and when the prices hold support, that is known as the neckline. Okay, so prices rises, left shoulder price rises to a peak and then declines. Then price rises above to form a former peak, creating a new peak, but before declining again back down into that support. Then price is trying, make another attempt to rally up. What happens? Fails right there, okay, and declines again. Now we're going to look to basically short the break of this neckline. And if we draw, again, if we from the head to the neckline, if we draw a flat, horizontal, vertical line, and we take that vertical line and add it under the neckline from where the price is broke, that's going to be our price objective. Okay. So let's just recap here what we've covered, some of the continuation patterns. Now, please note the important word, continuation patterns. So you have to play these patterns in the direction of the previous trend. So if after an uptrend, you get this resting pattern, that's a flag. I'm gonna look to buy above here, place our stop below here. After an uptrend, price from this pennant pattern, same thing. You're gonna look to buy it above here, ride it higher. Here again, on the wedge side of things, price a wedge like this, look to buy. Rectangle, same thing. But you notice how we're trying to play continuation of that first initial trend. Now here are some reversal patterns. These are trend reversal. This is how the trend reversals might occur. Head and shoulders, right? Head, we get left shoulder, head, right shoulder. Look to short when the price breaks this trend line and look for prices to go down. The double top and double bottom we also covered. Price makes a little M top here, look to short. Triple top, same thing as a double top. Instead of testing it twice, it tested 3 times and then it breaks down. All right. A spike is similar to the head and shoulders, just that the spike is much more, I guess, longer in nature. The diamond pattern is basically a stage 3. So if you remember earlier, we covered stage 1, stage 2, stage 3, and then stage 4, right? Stage 1 sideways, stage 2 uptrend, stage 3 choppiness, stage 4 back down again. So this diamond pattern is more often seen on stage 3. So after moving up for a while, after the prices have been going up for a while, you start just chopping around. And when you connect these highs and the lows, you get a similar shape to a diamond. So when the prices break that diamond, you're going to look to short and look for prices to move down. Okay. Saucer. Now saucer is a mixture of head and shoulders and a triple top, where prices, here make a left shoulder, make a head, make a right shoulder, but then make another shoulder, right? That becomes a saucer pattern, which you're going to look to short. And again, you can also call it a wedge pattern. All right, so let's start with the sniper swing strategy. So this strategy is best suited for 1 hour charts and 4 hour charts. However, it works really well on daily charts as well. But I really suggest using this on 4 hour, 1 hour, or daily, and not trying to use it on a chart below the hourly chart. Now, it'll work just as well on, let's say, the 30-minute chart, 15-minute chart. If you're a day trader, I mean, you could definitely use that. However, I've personally have only traded this strategy on hourly and 4 hourly chart because that's just my style, and thus the name of the strategy called the sniper swing strategy, right, for swinging. So, criteria with this strategy, we're mainly looking for one of the patterns mentioned above, the one of the patterns that we covered earlier, right, the flags, the pennants, the wedges, the triangles. So we're mainly looking for one of those patterns, to playing it at the trend line, or we're looking to play bounces and rejections of the 4 hour, 1 hour chart. So here's how we play it. Okay, here's how we enter. Once we find a currency pair that is running up to a downtrend line, right, or selling off to an uptrend line, we are looking to buy as close as we can to the trend line, right, preferably at the trend line. Okay, and once we get in, we will place our stop loss, at least 10 to 30 pips below the trend line, but preferably above or below a 4 hour candle or pivot point. So, remember in earlier chapters we covered what is a pivot, the level 1 support, level 2 support. So ideally your stop losses should be under a level 2 support or a level 1 support or below a pivot, or once you're buying, let's say, a pullback into the hourly or 4 hourly trend line, your stop loss should go below that bar. So you're going to wait to let that bar close, and then you'll put a stop loss below that. Okay, so that's what we're typically trying to do, but make sure you're giving it a minimum of 10 to 30 pips. Otherwise you're going to get taken out a lot of those trades only to see them work anyway. So here's an example. Okay, so you see how there's a trend line right here. Okay, and once we had this trend line, right, and once we connect it again here, right, so once you have 2 points, you can connect your trend line and extend it forward, and then the next time it touches it, you're going to look to short. Okay, so in this example, we take this, we have this point number 1, the swing high, right, then we have point number 2 right here, the swing low, another swing high. So the next time when it comes up into it, we have a confirmation that this trend line has held 2 times, so it's ideally going to hold again. So third time when it comes up into it, we're looking to sell this currency pair. Okay, so we sold it here and it drops down, nice trade. Then look what happens, it comes back up again right into that trend line, and look what happens, immediately starts selling off again into the red bar. So we're looking to short the tests of these trend lines. Now here's another great example on the long side. So now we see here, once we have this first touch, then we have the second touch, let's just even say we have the third touch, then we will draw this line and connect it forward. Okay, that's our uptrend line, and simply what we have to do is that every time it pulls back into it, we're going to look to buy. Okay, so we see here it pulls back, let's say we bought it, or let's say we bought it here, or let's say we bought it here, right? And whenever you buy it, you're placing your stop loss below the support area. So your stop loss is going right under here, and look what happens, prices are holding this trend line, moves up higher again. And now look at this again, prices drop back down to the trend line. Let's say you bought it at the touch of the trend line, your stop loss go below this bar by about 10-30 pips, prices start moving back up again. Now, the problem with this strategy is that it is too simple. Well, you might say, hey, isn't that a good thing? Simple strategies are good, and it is 100%. Simple strategies are good. Now, the problem with this simple strategy is that most people won't follow it, right? Most people don't do it. And the reason for that is they think, oh, this is too simple. This is way too simple. I don't believe it. There's no indicators on it. There's no, fancy systems on it. There's just no moving average. There's no oscillators, RSI. There's nothing in there. This is way too simple. This cannot work. And, they let their thinking get on the way. I mean, the simplest things in life are the most beautiful things. And the most often, they are the things that are overlooked by people, right? Because they think, oh, it can't be this simple, man. It can't be this simple. And they keep looking for the complex holy grail strategy that just doesn't exist. I mean, the charts are in front of you, right? Look at this. Shorter the crest of the trend line, prices go back down. We're buying tests of these trend lines, prices go back up. I mean, literally, trading could be as simple as you can make it to be. But most people often either don't believe it or they try and overcomplicate the strategy. So here's the thing. Now, once the trend line is broken, okay? Once the trend line is broken, that is often start of a new trend in the opposite direction. An opposite position can be taken. However, there are a lot of shakeouts and fake breakouts, so it's often best and better to wait for the hourly candle to close above the trend line. Even better is a retest strategy where the broken trend line on the way back to it becomes support resistance, and a lower risk position can be established using the trend line as the entry and the prior area of contact as your stop loss. So what does this mean? Well, pretty simply what it means is, let's say you were watching this currency pair for a long, all right, you bought it here, it worked. 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 Now let's say you bought it again here and it doesn't work. That's fine. We can get out, take our small little loss. But then what that also means is, all right, this uptrend is now broken. Okay, so you can sell on break of those trend lines. Place your stop right above there and look for a move down. Because once the trend is broken, it is often the start of a brand new trend in the opposite direction. Okay, so that's what simple means. Now, what we're going to do is either we can short on a break of this trend line, or we're going to let it break. Okay, we're going to let it break and just leave it, don't do anything. And then on the way back up, okay, on the way back up, what happens is this trend line, which was support all this while, will now act as resistance, and prices will come back down, touch the trend line, and then drop. That is called a retest, right? When we covered in earlier chapters that when there's support, when support breaks, it becomes resistance. Same thing here. When the trend lines break, right, on the way back up, now they become resistance. All right, so here's another example. Look at this chart. We get point number 1, we get point number 2. What did we do? We drew our trend line, okay? And we're gonna look to buy bounces off this trend line. So once you have point number 1, once you have point number 2, we got our points. Look what happened. Third time it came back down, right? Touch the trend line. Let's say we bought it here. Prices move back up and continue higher. Let's say the prices pull back down again. We bought it again. Prices move back up. So every time, let's say we're making 100 pips, and look what happens. Prices break, right? So let's say the fourth time we tried buying it again on this touch of the trend line. Okay, place our stop loss 10 to 30 pips below, and we stop out. But that's fine, right? Because look at this, we made 100 pips here, we made 100 pips here, and this trade we tried buying it again, it didn't work. We lost, let's say, 30 pips. Net we're still up on the long, and now when it breaks the trend line, we can either short it and it drops, or we wait, right? So we waited, it dropped. Let's say we missed it. On the way back up, look what happened. This trend line, which was bouncing off it earlier, now it's failing at it. So next time you're going to look to short as close as you can to this trend line. Place your stop loss 10 to 30 pips above this trend line, and bam, you get another drop again. And on this little drop here, your target trade profit will get hit. So that's what we're looking to do, right? The trend reversals are often the fastest, okay? Because everybody who's been buying all the way here, suddenly everybody's looking to exit on a break of trend. There are many algorithms and trading programs and black boxes and trading systems, automated systems that are built just based on the strategy, and that is the only reason that these trend lines work really well, because there are tons of software programs, systematic traders that are programmed to buy and sell break of these trend lines, and that is what causes these trend lines to work, right? Because every time it comes to the trend line, there's an algorithm wanting to buy it. So that's what it is. So in this case, we're buying the touches of the trend line, making money, right? We buy it again, we lose some money, comes back up again, we short, and it drops down again. So that's what we're looking to do. Now, there's a little problem with this strategy, okay? And here's the problem. First time it happens, second time it happens, right? People draw their trend line. The third time it comes down, they don't trust it. They're like, you know what? I'm gonna wait. I'm gonna wait for more confirmation, and it works, and they miss it, and then it comes back down again. They're like, oh, I'm definitely gonna buy it. I'm definitely gonna buy it, and it comes down. They still don't trust themselves. They're like, no, it can't be this easy. It can't be this easy, right? And they miss it, and the prices go back up again. And what happens? They're like, okay, fine. This strategy is golden. Anmol taught me a really good strategy. I know it's simple, but it works. I found the holy grail. Yes, it worked here, it worked here, it worked here, it worked here. I'm definitely gonna buy the next one. What happens? It pulls back, and then they buy the next one, and it stops out. And they're like, man, I knew it. I knew it couldn't be simple, right? I knew trading couldn't be this simple. This strategy is not good. Anmol taught me wrong. This is not a good strategy. I'm just gonna find another strategy. I'm going to take another course. This is not good. This is definitely not a good thing. And what happens? They get stopped out and then just confuse themselves rather than just waiting, dwelling on what just happened. Why don't you just sell the position and profit from that? And that's the thing with this strategy. The fact that it's so simple, most people wait for too much confirmation. And waiting for too much confirmation is never a good thing. Right? You only need 2 touches to draw your trend line. Third time it comes in, just buy it, right? That's what you need to do. Don't wait for it to confirm or work first, right? Because by the time it's ready to work, now the pattern is too obvious. I mean, think about it. People are buying it, people are buying it, people are buying it third time, people are buying it fourth time. Now, fifth time, everybody and their mom can see the setup, right? Their family can see the setup. Their brother who's never traded can see the setup. Their hairdresser can see the setup. The cab driver can see the setup. Everybody can see the setup the fifth time, right? Everybody can see the trend line by the time it comes here. And then that's the time the market makers break it. That's how it works. So don't wait for confirmation, okay? Anticipate the setups. Here's another example of it. Look at this. One line, 2 line, we drew the lines. Third time, touches it, we buy it, moves higher. Fourth time it touches it, we buy it, moves higher. Fifth time we try and buy it, it doesn't work, we lose small money. And what happens? On the way back up, trend line becomes resistance, we sell it, and then we make money again off it, right? And notice here another thing I want to show you here is that, look at this. Notice this pattern right here. What is this? So let's even take our trend lines for a matter, right? Let's say we don't do the snapper strategy, but let's take this for example. Do you guys notice this pattern right here? Yep, you got it. That's a bull flag, right? That's a bull flag. So that's what you're trying to do. Once you get your 2 touches, just buy the third one, right? And sell the break of the trend lines. That's what you got to do. Or just buy the bull flag. I mean, anything that suits your boat. Now this second one was 100% one of the best setups out of all this chart, because not only are you getting a pullback to a trend line, not only are you getting a bull flag, you're also getting a nice strong move and a 38.2, 61.8 kind of retracement here. So you're getting all these three things coming together. Fibonacci support, you're getting your bull flag, getting a touch of trend line. All 3 are one thing. This setup will work. And look at this. Bam. Wide ridge green bar. Because there was a consensus. Everybody knew this is a great setup, right? The price action traders knew this is a great setup because it's coming to the trend line. The pattern traders know it's a great setup because it's a bull flag, right? The relative strength traders know it's a great trade because it's coming after a nice bullish move. Okay? So this was the best setup out here. But again, even if you bought this one, it worked. Right? If you even sold it here, it worked. Right? So notice these things and try and be in them. And don't wait for confirmation. Just anticipate. Once you have your 2 touches, just anticipate the next one to work. If it doesn't work, we're going to lose a little bit. That's fine. Cost of doing business. Here's another example right here. Right? 1 touch, 2 touch, that's it. We draw the trend line. Third time it almost comes to it, sell, it drops back down. Fourth time it comes to it, sell, it drops back down. Fifth time it breaks it, right? You buy it long, and bam, it spikes back up again. See that? So that's what you're going to try and do. And again, if you notice here, we have this top line here, but if I take this top line and even draw a line right here at the bottom, we also get a channel type pattern. Now notice this again here. One touch, two touch, we draw a trend line, and just, I mean, this is a monster trade. I mean, literally guys, if you have the patience, right, to hold on to trades like this, you literally need just one trade, okay? Just one trade like this to make your whole year, to make your whole month. I mean, just take this for example. One touch, two touch, we draw the trend line. Third time it comes in, we buy it, moves higher. Fourth time it comes in, we buy it, moves higher. Fifth time it comes down, we buy it, moves higher. Sixth time it comes down, we buy it, moves higher. Seventh time it comes down, we buy it, doesn't work, lose a little bit money, and flip it short. Now we sell it, and this currency pair keeps dropping, right? And now when it's dropping, what you can do is now you can take a trend line from here and draw it like this here, and every time you keep on selling it here, right? So that's what you got to do. And as I alluded to earlier, this is what most people will do. They'll draw this trend line, okay, but they'll only see it when it's time, let's say about here. They're like, oh, this is a great trend line, it's held so many times, right? It's held 5 times, 6 times, this is a great trend line, I'm gonna buy. And then they buy it here and it stops out, right? That's what happens with most trade, and then they just keep going in circles and circles. Whereas if you're early, that's where the best trades are, third and fourth. So as a trend line trader using the sniper swing strategy, your goal, okay, is to buy or sell the third touch and the fourth touch. Those are the best ones, okay? The third touch is usually the one that will almost always work. The fourth touch will have lower odds than the third one, but it'll still work most of the time. Usually the fifth and sixth touches are the ones that are a bit shady. I mean, they might not hold every time, the fifth and sixth touch, okay? So usually the fifth and sixth touches are the ones to, you know, maybe avoid, because fifth and sixth times are when it's most likely to break, right? When the pattern starts becoming too obvious, when the trend line starts becoming too obvious, that's usually the time when it fails. So again, you're going to look to buy the third one, the fourth one, you know, maybe even the fifth one, but usually after the sixth one, you want to try and avoid those touches, okay? But again, you could still just trade it on every single touch until it breaks, and when it breaks, you sell it on the opposite direction, okay? So again, this is a really simple strategy, but most people still seem to mess it up, you know. And just try and take your emotions out of your trading, try and take your own ego and your own psychology out of trading, and just try and do this simple system to make some money. Now that is just one way, which is buying here, selling higher, buying here, selling higher, buying here, selling higher. But another way is, as I alluded to earlier, let's say you buy one lot here, right? On the way up, you only sell half, okay? When it comes down, you buy another one lot. When it moves up, you sell half. When it comes down, you buy another one lot. When it moves up, you sell half. You buy one lot. When it moves up, you sell half. When you buy it, it moves up, you sell half. When it breaks the trend line, you sell all of your position, okay? So now look what just happened. You locked in, let's say 100 pips on half your position, 100 pips on half your position, 100 pips on half your position, 100 pips half your position, 100 pips half your position, but you also have half left over all the way from here. So now you have one lot, two lot, right? One lot here, two lot, three lots. So you have three lots still going all the way from here higher, and you'll sell all of them when it breaks the trend line. That's how you can really compound your returns as an active trader. Again, here's another example. Now, these are all similar examples. I'm going to keep showing you these examples because my goal is to drill this strategy inside your head. And your goal right now, after taking this course, is to draw trend lines on all your charts. Just get in the habit of finding these, get in the habit of building your pattern recognition, and get in the habit of trading these and being able to spot these in real market environment. Because I can show you all the slides I want,
I can show you all the examples of all the charts I want, but until you actually find them yourself, your pattern recognition won't improve. The only difference between me and you, the only difference between a great trader and a person who's just starting out is more screen time. I mean, I've just seen more charts than anybody else. That's what makes me good. Okay? And so it's learnable. You can learn too. If I can do it, anybody can do it. So check this out here. First touch, second touch, we draw the trend line. Third time we sell, drops. Fourth time we sell, drops. Fifth time we sell, drops. Sixth time we sell, drops, right? Now it breaks the trend line. We can either buy or we can wait for the retest. And look what happens. This trend line, which was resistance all the way, holding the price down, when it finally broke the trend, and look what happened. On the way back down now the trend line, which was earlier resistance, acts as support. We look to buy the retest, prices move up. And now we can just simply draw our uptrend line and just keep doing this, because markets move in channels, okay? Forex currency pairs move in channels. Once this downtrend channel is broken, we get into an uptrend. Now we're simply going to repeat it again. We're going to try and buy all the bounces to the trend line. Okay? Alright, so in this chapter we're going to be covering the concept of divergence. So divergence usually are spotted using the indicators such as RSI, MACD. Some people even use stochastics, but most popular ones are RSI or MACD. So when the trend, okay, so what is divergence, right? So when the trend of those indicators, okay, diverge or differ from the price action on the chart, this is known as divergence and can be often, it can often lead to explosive moves in the direction of the indicator's divergence, okay? However, I personally do not really use indicators, as just reading price action alone can help us in spotting divergence, okay? Now we will cover this a bit later, but we will dive into first taking a look at divergences using RSI and MACD right now. But keep in mind, okay, indicators and oscillators such as RSI and MACD, they are based on the price, right? So the price happens first and then the indicator happens. So they are based on price. So if you can learn to read the price action, all right, you don't even need to look at the indicator. So I'm going to show you how we can do that, and it's a bit more advanced, but we'll take a look at that. So let's take a look at here. You see this chart right here? Now price was trending down, all right, and making lower lows, right? Low and another low, all right? So price is going down, making new lows, all right? Whereas if you look at the MACD and look at the slope of MACD, MACD is actually making a double bottom, right? Even maybe you could make a case it's a slightly higher low. So while the price is making lower low, MACD is making double bottom to a higher low, right? Though this signals that an upside momentum is coming up. And look at what happens after. Shortly thereafter, prices bounce to the upside. So this signals to us that maybe this low is not going to hold and prices are ready to move back up. And look what happened, right? Prices move all the way back up. And MACD signaled that to us, okay? Now take a look at this one. Now, we can spot divergences without even using the indicators by simply looking at the price action, okay? Now I'm going to teach you without even having the RSI or MACD on your chart, how you can spot the divergences. Now, you can, when price is making a new high, all right, or new low, but then fails to follow in the direction, that will usually coincide with the direction. So you can see here, markets made a new high and then, fall back down. Market made a new high, right? Fall back down. Market made a new high, it fell back down. Market made a new high, it fell back down again. So when every time prices make a new high and then they go back lower, that signals to us that there is divergence. Okay, here's another example. Take a look at this chart here. Prices make a new high and then they go lower. Prices make a new high, then they go lower. Prices make a new high and then they go lower, right? So we already know just by looking at the chart that there is divergence here, right? And we can confirm that. Now we just added MACD onto the chart. And look at that, the MACD is confirming the divergence, right? So same chart showing divergence on the indicator. So price was trending higher, but the MACD was trending lower. So as the prices are making higher highs, the MACD is making lower lows. So this is giving that indication that a reversal of price action might occur. That if the price was to break this upward trend line, prices are going to go sharply lower. And you can see here, this is a trade that I took. Here's my short entry, place my stop loss right above, and place my target down in here. Right? So this signals that when the trend breaks, prices are going to go lower. And look at this, look what happened, right? After breaking that trend line, prices fell sharply lower on the break of this trend line, almost heading up into the target area. Here's another example, right? So, it is important to understand what we are looking at with our indicators, okay? Remember, divergence showing up on our MACD or any other oscillator is nothing more than a calculation of price. So it doesn't make sense that we should be able to, see the price, without even looking at the indicator, correct? So, here's an example we can see and understand to confirm along with our MACD, and we call it the price is rounding off, right? So you can see here, price makes a new high, falls off, makes a new high, falls off, makes a new high, falls off, right? And this is kind of like a rounding type of price action, okay? So notice how each time price makes a new high, it is quickly rejected and the price moves down. And then again, comes up, makes a smaller high, and then rejects again. By the third time, we have a good idea that the momentum is fading, right? Logically, price can seem to gain momentum to the upside, so this translates into divergence. Now, we can confirm this by adding the MACD, and you can see here we added the MACD on the chart. Look what happened. Divergence is confirmed. Price was making new highs, while the MACD is making lower highs. So when finally prices are breaking here, look what happens. This drop sharply lower, okay? So this is the rounding effect and a failure to hold a new high. Now here's another chart. Look at this. Price is trending higher, but each new high is not holding, okay? Makes a new high, drops. Makes a new high, drops. Makes a new high, drops. And look what happens. When we break the trend line, that's our short entry, and sharp move down on the break of the trend line. Bam, right? We added the RSI on the chart, and look what happens. Price was making higher highs, but the MACD, all right, is making lower highs. So RSI confirmed this divergence. Here's another example, okay? New high, falling, not holding, new high, not holding, new high, not holding. We break this trend line and bam, sharp move lower, RSI confirms the divergence. All right, so that was a chapter on divergence. It's a really good concept to spot these on your charts. But here's a little quiz. So let's just see, what can you spot here? Can you spot any patterns that are playable? Pause this video for a little bit and think about it. Are there any patterns that you see here that are playable? I can already see 1, 2, 3. I can see 4 patterns. I can see 5. I can see 6. I can actually see 6 trades in this pattern alone. And here you go. All right, so in this chapter we're going to be talking about management.
The setup, like from 10th November, all right. So this is the 2 times it touched. You connected it. The 3rd time you can buy it. So you bought it on 27th November, all right. So from 27th November, you're basically riding one position till the new year, 30th December. So that's like a month. Can you hold on for a position for a month? Right? It's all a matter of patience. Can you hold on for a month? If you can, let's see what you would have made. Let's say you bought it here. You sold it on the break. Wow, you just made 470 pips. How would you like to make 470 pips in a month for doing nothing? Just for holding on. Just for holding on. How would you like to make 470 pips just for holding on to a trade? Or even better, if you don't have the patience, you can buy this thing here, sell it here, but make sure you buy it again, right? So a different type of trader could even maybe optimize it. So let's say you buy it here, you sell it for 180 pips, okay? And then you buy it again. Let's say on this test of the trend line, sell it here. So you made 200 and let's just call it 200 pips, okay? And then you can wait for it. The next test, you buy it here, sell it there. You made another 160 pips. So you can do that too. You can just buy it, sell it, buy it, sell it. But if you just hold on to it, you're just going to make a lot more money. Exactly. And you're going to see entry points every single day. Every single day. There's always a currency pair either running up to a trend line or selling off to a trend line. The only question is, are you going to take the trade? Because sometimes you're going to take some stop losses, right? Sometimes what happens is they take some tries, right? So like you might get in on the trend line and it just suddenly peaks below, it stops you out and then ends up closing above the trend line. Sometimes that happens. But, you know, like if you're losing 10, 20, 30 pips at a time, you can try it 2-3 times, because once you catch it, you're off to the races. So, I mean, that's what it's all about. And even look at it here. When it actually went into a downtrend, all right, look what happened there. Now, you know, you can look to short these retests, you know, of the trend lines. Look at that. Oh my God, perfect. Right, so once you got these 2 points, the third one you short, the third one right here, you short that, and you got to move back down again. Now you can cover it here if you like, or you can hold on because it's still below this trend line. It could just keep on, or it could just keep on doing this, right? Just working its way down. Yeah. Okay. So any more questions about this setup? Any more questions about this setup? Let me know. Okay, good. So do you guys want to keep on continuing, or do you guys want to take a 30-second, 60-second, 2-minute, 5-minute break? Let me know. Up to you guys at all. You guys want to take 2 minutes? It's all good. Yeah, so that's the best part, because the way I trade, George, the way I trade, like I don't know anything about fundamental. I'll be honest. Like I'm like Forrest Gump when it comes to fundamental. I know nothing, right? So all I do is like I just play any currency pair for all I care, as long as the spread is tight, as long as it's liquid, in that regard. I mean, I'm not gonna go and trade like the Singapore dollar, or maybe I could, but like I wouldn't go trade like the ruble or like the Indian rupee or anything. But I would trade anything else, right? So this is what I trade basically. If you guys want to take a screenshot, you can take a screenshot. All these pairs I will trade. I will trade all these pairs. If you want to take a screenshot, you can go ahead. This is all I trade. But sometimes I might trade something else too, because all I really care about is the trend line, right? Yeah, so because it's all about the trend line, right? So it could be anything, because a lot of times you guys won't even believe, okay? A lot of times, like I'm quickly flicking through my charts, okay? I'm just kind of dragging and dropping and flicking through my charts, and I might see something. Oh wow, this is at the trend line. I might have my one-click trading enabled, right? So what I do is like I have my one-click enabled trading with like let's say a mini lot, right? With a mini lot, I have it enabled with like a mini lot. Sometimes I don't even know what symbol I'm trading, what currency I'm trading. I just drag and drop. Oh, this is setting up, boom, I just press sell, drag and drop, oh, it's setting up, boom, I just press sell. A lot of time I don't even know what I'm trading. So then when I've gone through this list, then I'll take a look at what positions do I have, and then I'll analyze it correctly, daily, 4-hour, everything like that. And then I'll decide, okay, this one's actually looking pretty good. I'll increase my position. Let's say I'll add 0.9 lots more to get into my one lot, right? Or I might decide, yeah, this is good, but the daily looks like it's pretty bullish, so I don't know if I want to go against it. Then I might just press X on my position, and then I'll just close out my mini lot position. Yeah. So a lot of times I literally have to go back and look which currency pair was that, because I just trade the pattern, the chart, right? I don't even need candlesticks. I can just trade off bar charts, because all I care about is the trend line. Yeah. So that's that. So let's do this. Let's take a quick 5-minute break. Okay.